Lee, welcome back. It's nice to talk to you today.
Yeah, well, I'd rather talk to you on a different kind of day, but I'm here.
Yeah, we would as well. What do you make of it?
Well, I think your next guest ought to be somebody from the SEC to explain why they have sat back calmly, quietly, without saying anything, and allowing these algorithmic, trend-following models to wreak havoc with what has up to now been the best capital market in the world. Okay, and they don't seem to say anything. You know, in the mid-1930s, they instituted the uptick rule to deal with the abuses of 29. It worked effectively for 70-odd years. They took it out in 2008 for some unexplainable reason, and they've created a wild, wild west environment in the stock market. And this volatility is destroying confidence. Now, what I know from 50-odd years of investing, you know, bear markets don't materialize out of immaculate conception. They come about for certain fundamental reasons that the stock market is seeing. So number one cause of bear markets is the stock market smelling an oncoming recession. I won't cite all the economic data, but there's just no signs of recession. The ADP, flash employment number, the economy is growing. Is it going to grow at a slower rate next year than this year? In all likelihood, but it's growing. Okay. Number two, inflation. Inflation is moderating. Inflation is now below the Fed's target. The third cause of bear markets is a hostile Fed. If anything, the Fed has been too easy, and the level of interest rates are totally non-competitive to the stock market, in my opinion, any kind of historical context. The 10-year bond is now, I was out this morning, but I think it was 2.8 something percent.
Yeah, 287, and it may be lower at this moment. It's 285 as we're looking at it right now, Lee.
Let me give you a statistic. Okay, in the last 50 or 60 years, the S&P multiple averaged around 15. Okay, we're using $172 in S&P earnings, so the market multiple now is about 15 times. But in that 50, 60-year period where the multiple in the market was 15, the 10-year government averaged over 6, currently less than half of that, and the average Fed funds rate was 5%, currently a little bit over 2%. Okay, so, you know, relative to interest rates, the stock market's a bargain. Earnings are growing, maybe 6 to 8% next year. The PE is very reasonable. As you know, I often quote the great line of John Templeton: bull markets are born of pessimism, grow in skepticism, mature in optimism, die in euphoria. Where's the euphoria? Everybody's looking over their shoulder, worried about things. And so, you know, I have to say that I would buy my favorite stocks here. Okay, I know what the issues are. We have extended profit margins, which tend to be mean reverting, but there's no signs that margins are heading down. The country is possibly moving to the left, which is a longer-term concern that I have. The young people today don't embrace capitalism, okay, and that's a problem. Third, we have a debt problem. There's no question about it, but I don't know when that hits. And fourth, we have an unconventional White House that destabilizes people periodically.
But what if the economy, Lee, is slowing more dramatically than people think? And for a variety of reasons, whether
ask me that question when the market's up 50 S&P points, not when it's down 50. All I know is earnings are coming in better than expected. Earnings estimates are going up. There were 2 or 3 companies reported this morning. I'm a little out of touch, but my team sent me an email. They were better than expected. Guidance was increased, etc. You know, in 1987, during the portfolio insurance, and I guess I should make the point. I've lived through these periods in the past. We had portfolio insurance, okay? The market one day dropped 22%. Everybody yelled recession. There was no effect on the economy, okay? People are less involved in the stock market today than they were involved back in 1987. And the market is now down 10% from the high. It's just a correction for the market. There's no sign of a trend change. But if you want to hypothesize we're going into recession, sure, we'll all be wrong. We won't earn $172 in S&P earnings. We'll earn 20 or 25% less, but there's no signs of that. You're just responding to a market. Okay. In January, you were probably, your team was nervous that the market was going to the moon. So these trend followers, basically they buy an up market, they sell a down market, they exaggerate the moves, and that's my position. Now, I could be dead wrong, but my position is based upon no recession, Inflation, not a problem. The Fed is far from hostile. Okay, bonds are non-competitive with stocks. Earnings are growing. Employment is growing.
What do you make, though? What do you make of the move in yields? Why is it happening the way it is? I don't know very many people who expected the 10-year today to be at 285. You know?
I would agree with that, but I think it's a very complex situation. If I put on my screen bonds around the world, okay, in Germany, their 10-year rate is 38 basis points. Okay, in Italy, it's 3% with all their problems. In Spain, it's 1.5%. Okay, in Sweden, it's 0.4%. In Japan, it's 7 basis points. You imagine lending money to Japan for 10 years for 7 basis points, or lending money to Germany for 10 years at 39 basis points? So these low interest rates around the world are affecting our interest rates.
So you think it's the yields around the world are distorting our yields here, rather than the bond market trying to sniff out a more dramatic economic slowdown?
Correct.
What about
that's right. I could be dead wrong, but that's my view. Yeah.
What about the issue with China? I mean, that's front and center for obvious reasons.
There's no question that people are nervous, but at the end of the day, you know, we live in a global economy. If China wants to sell their goods to us, they're going to have to accept our monetary liabilities. It's a closed circular system. It's not in anyone's interest to go push us into recession, create social unrest. You know, part of this whole move to the left is because of the unequal sharing of economic prosperity. The Fed wants economic growth. They want more employment. Okay, and so you got to assume that monetary policy and fiscal policy and governmental social policy is going to be designed to promote economic growth. And you could come up with any scenario you want, and I'd say that not to be a wise guy, because it's not my style. As you know, at the beginning of the year, I told you the market was in a zone of fair value,
right,
and I think it's down 1% for the year. We've had a 10% correction. But when you guys have a special session tonight to talk about the market weakness, that will mark the bottom.
But did somebody pass you our programming notes?
From your lips to God's ears.
Let me ask you this. You say a bear market doesn't appear out of thin air. Can't you also make the case that we've had a rolling bear market since the beginning of the year?
So we've had a significant correction, absolutely. I would say that, frankly, I would be the first to admit, if you were strictly a technician and just looked at market prices, you'd have to conclude we're in a bear market. I am not a technician. I'm a fundamentalist. So in my 50 years of doing this, what do I look at? I look at the economy. I look at inflation. I look at monetary policy. I look at valuation. I look at bonds versus stocks. And everything comes up, you know, saying it's a great buying opportunity. You know, and that's as simple as that. And I have a certain discipline. Could I be wrong? Absolutely. You know, my mistakes could be paraded up Fifth Avenue 5 abreast. But I think what's going on has a lot to do with the mechanics of the market. The technology is overpowered the market's ability to deal with it. In 1987, it was portfolio insurance, the rage of the day. You don't hear about that anymore, okay? In 2000, everyone wanted to be in high technology stocks. Cisco was 100 times earnings. Everybody's perseverating over Google, a fabulous company with a fortress balance sheet that should be using more of their cash to retire their equity, is a little over 20 times earnings. You know, you don't have the kind of excesses that you had back then, okay? You know, we had Nifty 50. I remember distinctly in 1972, I won't mention names, one of the star salesmen at Goldman Sachs, I was running research at the time, told me that we could close down the Goldman Sachs research department because all you got to cover is 50 companies. They're the world. Okay, and in that 50 companies, Avon, Xerox, IBM, Merck, and the philosophy of the day was we don't care about what we pay for the business as long as they're a world-class growing company. And then 73-4 hit the OPEC embargo, inflation, recession, and a bunch of those companies fell out of bed, basically, and it took, in many cases, more than a decade for them to recover in price. So I lived through portfolio insurance, I lived through Nifty 50, I lived through the high-tech boom. At the end of the day, 2.8 in a 10-year in a growing economy and a 15 multiple in the market says I would want to be buying stocks. I would change my mind if what I thought was going on in the economy, in the market, would dip us into recession. But as I pointed out, in 1987, you had a 22% drop in a day, okay, and everyone was yelling recession, and you had no recession. The economy continued to grow. And similarly now, we're down 10% from the high. We're doing things more fast, more rapidly than I would have imagined. But basically, it's a 10% correction, long overdue. And it's painful, but I'm more concerned they're scaring the hell out of the public. I just don't understand these models, and maybe I'm old-fashioned. Somebody once said, if you don't understand Bitcoin, it means you're old. I'm old. I know it's worked for me, and I'd say that common sense suggests to me that the regulators have to focus attention on what this new technology is doing to the market, the volatility it's creating. And, you saw it in January when everyone marked up their expectations for the year. You saw it in February where everybody marked down their expectations for the year. And it's kind of crazy, but you got to keep your head about you. And, when everyone's losing theirs. And I say that everything that's worked for me for 50 years of investing would suggest that we're near a low.
Lee, a couple questions. It's Steve. First of all, I agree with you on algos, and they're about 50% of market activity on a lot of days. And I also see no reason why the uptick rule was ever removed from the market and should be put back in the market. That aside, there was some euphoria in the market. When you take a look at some of the stocks that
Steve, I agree. There's always a pocket here and there of euphoria. There was, but there's no broad scale.
No, I
agree. The public is looking over their shoulder. They remember 2008. They're committed to not get caught again. Okay, and they're very nervous.
But let me get to the point. So the point is that we had a big wall of worry that we climbed, that got to the top of the market, and everything was going in investors' way. Rates were going down, employment was going down, monetary policy the world over, synchronized global economic expansion. Now, as we got to that top of that wall, it's going the other way. So why shouldn't the market correct? And why is 15 the right number when we don't know and 15 may be the right number? That's an average, which means it can go lower to get back to the average. So, yes, you've got a Fed that now is maybe going to pause a little bit. But adding to that, to everything going against you, you've got an unstable administration. Anybody would agree on that has not been honest coming out of the China issues. The China issues are real. You've got Germany that showed some contraction, last economic numbers. Japan showed some contraction.
Germany is all tied to autos, and autos in recovery in the fourth quarter.
Exactly, but whatever it is.
Steve, you're making it sound like the stock market is very homogeneous. What's homogeneous is the bond market. If you look at a AAA bond, all AAA bonds trade within an eighth or a quarter of each other in terms of yield. The stock market is heterogeneous. Sure, there are stocks. The average stock is 15 times earnings, but there's stocks at 20 times earnings, and there's stocks at 8 times earnings. I'm looking at a list of things that we're willing to buy. AMC Network, 7 times earnings. Citibank, 7.5 times earnings. Dow DuPont, 10.5 times earnings. First Data, generating $1.5 billion a year free cash flow, trading 11 times earnings. Okay, less than 11 times earnings based upon our estimate. Alphabet is a little over 20 times earnings with a fortress balance sheet growing at 20%. So, you're a smart man. You're losing money today, but you're a smart man. And by the way, I think I'm not a moment-to-moment kind of guy, but I think the FANG stocks are trading better than the market today, which may be a sign that we're near end of this correction. But at the beginning of the year, I told Scott that I thought the market was in a zone of fair valuation. The market went up a big amount in January, maybe looked like I was too conservative, and then it got clipped in February. And I think we just got to, step back. And like I said, you have to decide what your discipline is. If you're a technician, you've been trading the market well because a technician has every reason to be bearish. 40% of the stocks in the S&P 500 are down by over 20%. The market's had a pretty big correction, acts terribly. Most money managers are having a very difficult year. But I step back and I just say, I'm being repetitive and I apologize, what do you think causes a big decline in the market? It's the economy heading to recession. It's inflation accelerating. It's the Fed becoming hostile. It's bonds being more attractively priced than stock. I'll tell you, bonds that are more attractive than stocks, where a lot of damage has been done in the high-yield market. You could buy some high-yield bonds that we think are decent, 11 and 12% yields, which I think are very competitive with the stock market. And the one thing I will say, I've said this repeatedly, and most people glance over it, if the 10-year government belongs at 2.8%, and the Fed funds rate belongs a little over 2%, and the Fed is getting close to being done, you do not make 10 or 15% a year in the stock market. There's a linkage between returns you earn in fixed income and returns you earn in equities. You make 6 or 7%. And before the last 2 weeks, you were running in that 6 or 7% appreciation track. And I think before the year is over, I'm guessing, and I could be dead wrong, the market will be higher than it is today on December 31. And I'm not a huge bull. I think the market's priced for 6 or 7% returns. I don't like our fiscal policy. I think we should not have cut taxes for wealthy people. We're developing a debt problem in this country. I just don't know when it hits. And my favorite story, two absolutely distinguished citizens were Pete Peterson and Joe Fowler, both deceased. But I remember in 1972, out of their own pocket, they paid for a series of ads alerting Congress and the public to the evils of the budget deficit. 40-odd years ago, in 1972, that's 46 years later, what do we have? We have a deficit worse than it was then, and we have the lowest interest rates in the history of the world. So who knows when the problem is going to hit? But all I know is that 2.8% 10-year government, 2% Fed funds, and a 15 multiple in the market, with the market with earnings growing. I'm not a huge fan of stock repurchase, but I'd say if I'm a typical corporation and my stock is anywhere from 12, 13, 14, 15 times earnings, and I can borrow money at 6% pre-tax, you're going to see a tremendous increase in stock repurchase.
Unless you think, Lee, that companies have borrowed so much money over the last 10 years because rates have been so low and they've bought back all their stock that now they're using money that they have from the tax cuts to pay off debt, to pay down debt rather than to buy back shares or deploy it to capital expenditures.
That's a very micro question. You got to look at it stock by stock. Just as I said to Steve before, the S&P might be 15 times earnings. I'm finding a lot of things at single-digit multiples in a world of single-digit interest rates. And everything I know and I've learned basically would suggest that the market is overreacting. Again, we're going crazy here. The market is still off 10% from its high. The market is quintupled since the bottom of 2008. You know, let's just not lose sight of things. People were looking for correction for 3 or 4 years.
Understood. Joe Terranova has a question for you, Lee.
Hi, Lee. I want to ask you about really what is troubling the market today, the reason that we're down so significantly. And you mentioned it before. It is an unconventional administration when we were told to take it seriously, but not literally. What about the potential that right now the market is pricing in this unconventional administration, the ability to knock down oil prices $25 in 30 days by making a phone call to the Saudis, a trade imbalance that we're fighting with tariffs, but now you wake up this morning and you really have more of a national security question when you're looking at the theft of technological intelligence. What about the fact that possibly we are pricing in this unconventional presidency that you talked about?
Well, I think it's a factor that's weighing on people, but at the end of the day, the president's conduct and deportment is more disturbing than his policies, with the exception of what's going on with tariffs, and we haven't seen the end of it. You know, he professes optimism that in 90 days they'll correct the problem. No one knows the answer. But basically, the president's policies, by and large, have been market-friendly. What's not friendly is his deportment. And I keep saying, you know, I'm not going to be the one to tell him how to deport himself because he's the guy that defeated 16 opponents and won the election. Would I like to see him conduct himself differently? Yes. Am I a believer in the law of comparative advantage? Yes. But, you know, it is what it is.
Well, you will. But you've also said, Lee, I mean, look, you know, there are a lot of questions and concerns about the deficit. That's a longer-term consideration, absolutely unequivocally. Now, if you want to tell me the market today and yesterday, meaning you know, Friday and 2 days ago and today, are reflecting the market's waking up to a fiscal problem,
I don't know. I mean, I would say that's probably you're reaching. You're reaching to try to explain the weakness in the market. And I'm saying the weakness in the market in large part stems from the fact that it's an old cycle. People are looking over their shoulders, worrying when it's going to end. There's no signs that it's ending. If anything, it's like rejuvenating. You know, inflation is moderating. You talk about the price of oil. By and large, I think 6 or 7% of the index is energy, and the rest is not energy. The decline in the price of oil is a tax cut for the rest of the world. It's a positive. It's not negative. Okay.
Well, Lee, below 50, it's going to be a negative, in particular for the high yield market. We saw that with
what percent of the energy market is high? I don't know the answer, but what percent?
15% of the high yield market is related.
So you have a problem in that. You know, you have a problem in that. I've been dead wrong. I own Neighbors. Neighbors is less than 2 times cash flow.
Well, the problem, Lee, would be in the high yield market for energy, similar to what we saw in 2016. It would be a drag if you see sustained prices below 50.
I understand.
Carrie Firestone's here. Lee, she has a question for you as well.
Yeah, so Lee, I was pleased to hear that you have some positive things to say about the FANG stocks actually being relatively positive today. And you look at what the Nasdaq's done, it was down almost 2.4%, and now it's down less than 1%, which is the sign that, you know, the sellers are out and maybe there are some buyers here. What I'd love to hear about from you is the following. On this economy, we live in a consumer world. 2/3 or more of the GDP comes from consumers. And think about what we know. We know that there are more people working than ever before. Wages have gone up, hourly wages 3.1%. If interest rates are lower, it helps with mortgages not hurt, and the lower price of gasoline is a positive for consumers. They got a tax cut, maybe not as much as corporations or the very rich got the biggest tax cut, but still the tax cut is a positive. So with Costco saying they had a 12% positive comp, it's really hard to see how things are collapsing and we're hitting a recession next year when every piece of evidence is that the consumer is reasonably strong and healthy.
So Lee, that's your perspective.
That's my point. That's exactly right. I mean, employment is up, consumer sentiment is up, basically, and I come back to my buddy Scott Wapner and I say, get somebody from the SEC to explain why they eliminated the uptick rule and what do they think about these quantitative trading systems that has created a tremendous amount of volatility in the market, scares the public, effectively raised the cost of capital to business. Why have they sat back and allowed this to go on? And maybe they have a good explanation. I'm 75 years old. I'm willing to learn.
You think Lee? You keep saying that you got this big tax cut, for the wealthy. There is the issue of part of that tax plan of the SALT deduction being taken away. I'm sorry?
The blue states versus the red states.
But we're talking about big populations. California, New York, New Jersey, Connecticut, Illinois. Do you think, I mean, look, people say that is in part why housing has rolled over in the manner that it has.
Guess what? What do you think the multiple is in Lennar? I don't own the stock, a very fine home builder. It's very smart management, know the business cold, second generation running the business. Lennar is 7 times earnings. The market has not been asleep. Okay, and again, I'm not making a case for all stocks, but relative to a 2.8% 10-year government, a growing economy, growing profits, growing employment, I think that the bubble is fixed income, not equities. Okay, and we're all going crazy because the market's down 10%. We're going crazy because of the magnitude of the moves, and I say the magnitude of the moves are related to these trend-following models. It's not related to the economy. I can't keep saying the same thing. There are long-term issues that I worry about, but I don't know that the long-term issues are hitting in 2018 or 2019. Mm-hmm. I just say the conditions that normally lead to a big decline aren't present. And the 10% correction is healthy. It could be 12%, it could be 14%. Basically, it's not a bear market. I ascribe to what's going on to extended margins, people worrying about mean reversion and profit margins, but more earnings have been exceeding expectations than not. Okay, I think country is moving to the left. To the young people, one of my heroes, I just love him, is Ken Langone, and he wrote, I love capitalism because he saw all the young people lining up behind Bernie Sanders abandoning capitalism, and he looked at Bernie as the Antichrist. Okay, and I think it's a long-term issue. The Republicans lost control over the House, and who knows what's going to happen in the Senate and the executive branch. We have a debt problem in the country. Okay, debt has been growing too rapidly, but I think it's really public sector debt, not private sector debt. Then we have this unconventional White House. So I know all the issues. But, we're not talking about a 17, 18 multiple market. We're talking about a 15 multiple market.
Pete Najarian's here has a question.
Hey, Lee, I completely agree with you on the algos, by the way. It's something I brought up just the other day on Monday, and I brought it up last night on Fast Money, along with the uptick rule. That was from 1938 till 2007 as a market stabilizer, and unfortunately, they have yanked that away. Now, there are a lot of folks out there that'll say, hey, look, Pete, you never mentioned that to the upside. It's far more detrimental to the markets when we see it on the downside because of removing that uptick allows these computers, which maybe it's 50%, maybe it's even bigger volume than people are projecting right now. So I completely agree with you on that. In terms of some of the buys that you talked about today, though, you talked about some of these single-digit type names. You brought up FDC. You brought up a couple other names. I'm curious about
DuPont,
Dow, DuPont, Citi,
AMC, Alphabet.
Right. AMC. Citi is the one that's interesting to me. I happen to own it as well. But
which one? I didn't hear you. Which one?
Citibank. What is going to finally get that stock to move? I mean, at the beginning of the year, I was one of the guys pounding the table. I thought it was going to 100.
Look,
it has not done that.
It's buy orders. They'll materialize. I believe Citibank is buying back 10% of their equity annually. They're generating a tremendous amount of free cash flow. It's it's yielding now over 3% or about 3%. Okay. I go back to January. Everybody, when the market put on the performance it put on in January, I don't have the number in front of me in terms of what it did, everybody raised their price objective to the market. And then all of a sudden February hit, and everybody lowered their price objective. Okay. And, I think you just got to keep your head around. You got to have a discipline. You got to have an approach. And my approach is fundamental. And when I look at a 15 multiple versus a 2.8% 10-year government, and I'm convinced. Now, let me just tell you this. If you could convince me we're heading into a recession, I change my whole view, because recessions tend to happen every 4 or 5 years. They last about a year. They take GDP down about 1%, and they take the S&P down 25%. That's a recession. But and they'll happen. That's what bear markets are about. But we're not looking at that. We're not looking at that.
Even if we were going to enter a bear market, do you think, as some have opined, that we could be in a cyclical bear market within a secular bull market, and it's a short-lived phenomenon rather than some long-lasting game changer where the goalposts have moved dramatically?
You got to, first of all, I mean, I think the TV programs create a lot of craziness where we're in correction territory, this territory. Bear markets, there are certain dimensions, not just the price decline. It's how long did the decline go on for. Bear markets last about a year. They're confirmed by economic contractions, okay? They're confirmed by the breadth of the market. We don't have that. All we have is had a violent correction of a short-term nature. Okay, it's going on for a couple of months. It's not like a typical bear market. Typical bear market lasts about a year, and the market is reasonably efficient. Let's go back to 2008 bear market. The average bear market was a decline of 25%. That market was down 54%. Guess what? The average economic contraction GDP is 1% peak to trough. That one in 2008 was over 2%. So you had a twice as severe bear market discounting a twice as severe average recession, which brought into play Mr. Bernanke, who figured the best way to get us out of the recession was creating wealth, and the best way to create wealth was elevate the stock market. Okay, so, there's a certain rhythm to things, and I would say, again, I'm being repetitive, I apologize, but I don't know any other way, is, if you convince me we're heading into a recession, and, the short-termers, the guys that want to have something to say at all times, they'll say, well, this market's telling you something. What did it tell you in 1987 when it dropped 22% in a day? It turned out telling you nothing other than portfolio insurance was a bogus concept. Okay, what did you learn in 2000? What you learned is you don't pay 100 times earnings for technology companies. Okay, and what did you learn? In the Nifty 50, there's no sure things. Everything is exposed to the economy. It's exposed to competition. Do you think now, back then, that IBM and Xerox and Avon were 60, 70, 80 times earnings? And these are companies that now that aren't even being viewed as real,
Yep.
So anyway,
Lee,
you got to keep your head about yourself. Don't go nuts. I expect the market to end this year. This is a call that I'm not good at, but my hunch is we'll be higher on December 31 than we are now. I'm breaking the cardinal rule. Arthur Burns was once approached by one of his PhD students, and he said, "Now that I'm graduating, Professor Burns, what advice do you have for me?" And his advice was, "Forecast well, but above all, forecast often." Another good line is, if you give him a price, don't give him a date. If you give him a date, don't give him a price. I think the market will end the year higher than it is now. I think that this is technical stuff, and you should use all the influence you have to get somebody at the regulator's level to come in and explain why they eliminated the uptick rule, why they've not reinstituted it, okay, what do they think they should do about these trend following models. Is a cost to the market, is a cost to capital by this volatility, which I don't think is fundamentally based. I believe 2 or 3 companies reported today, and they indicated business was very strong. I can't give you the guy's name, but I'm a member of a society of self-made men and women that have a charitable instinct. And I went to a board meeting a little over a month ago, and the head of the group is a guy that runs a major company. And he told me during the cocktail hour, and this is a man I would say is probably between 50 and 60, he said in all his years in business, he's never seen the economy as strong as it is now.
Look, we've heard it, Leaf. We've heard it from other CEOs as well. It reminds me of the Target CEO, Brian Cornell, saying the consumer environment, and he said this a few months ago, was the best that he has ever seen. It is dramatic, and it's somewhat jarring that the narrative has changed in the manner in which it has in the length of time that it has. I take your point. I want to thank you so much for calling in. Yeah. I can't think of a better day, a better moment, really, considering the volatility that we've had to talk to you.
I'm losing my tail today, but I can think of a better day. But, my view is my view, and we'll find out soon enough. The one thing about the market is nice. You find out whether you're right or wrong, in a not too distant future.